Hey friends, welcome to the channel. Are you someone who is living in Germany who wants to invest but is too overwhelmed with all the information in German out there? Then you are at the right place. This is the first video in the 8-video series of how to start your stock market investment from Germany. I made all these videos keeping a beginner investor in mind, and all these videos are meant to improve your financial understanding. If you are someone who is planning to start your investment journey, irrespective of which country you are from, there will be something in here for you. In this series, we will go step by step to get you familiarized with the basics of stock market and then move on to make your first trade. After that, we will create a balanced portfolio with all the stocks and ETFs. So if that sounds interesting to you, then keep watching. I was someone who always wanted to invest. The idea was always there in the back of my mind as soon as I started earning an income. But somehow I was a bit skeptical about the prospects or didn't know if I should really go for it. If that sounds like your situation too, then maybe this video will help you to finally take the plunge. But it could well be that you are someone who already knows the benefits of investing. If that's the case, feel free to skip this video and move to the next videos in the series. For everyone else, let's get started. Hi, my name is Srijit and I'm an engineer living in Germany. During my free time, I make videos about the two most important aspects of everyone's life, money and time. Everything said here are merely my opinions and the way I do things based on my own experience. I believe you have the wisdom to understand the risks and benefits and make your decisions wisely. We all have heard the saying that money doesn't bring happiness, but still for most of us, our life revolves around a job which brings a constant source of income. Why are we still after something if it doesn't bring any happiness to our life? The thing is, those who said that money doesn't bring happiness probably had lots of it. If you don't have enough money, it becomes a source of pain, anger and frustration. I understand that being rich also won't solve all your problems. But having some level of financial independence can help you to think beyond the money factor. You may not have to base the critical decisions in your life solely based on money. Those decisions concerning your health, your relationship, your job, all those things which brings real happiness to you. So when it comes to money, more may not be better, but having some level of financial independence is a good thing. Now, since we covered why we should be making money, let's go and check the next important question: how? In the modern world, there are two ways to make money, or should I say two legal ways to make money. First way is either to work for yourself or work for someone else. And this is the thing which we already know because we are doing it every day. And the second way is to make the money work for you. And that's where investment comes into picture. Investing means using your capital or money in a way to add value and grow. When you invest in something, you are buying an asset that you think will generate a return. And the most common way we all know to invest is just simply putting the money in the bank and receiving the interest. This seems like a totally sensible thing to do since your money grows with interest. But your calculation starts going wrong when you consider the inflation and the low interest rate offered by banks into your equation. We will talk about these things in detail later. As of now, I will give you 7 reasons why it's a bad idea to keep money in your bank account and why you should wait anymore to invest. Ideally, we'll all be start investing at birth. But let's face it, most of us don't think about investing until we are in our 20s or 30s, even if we have had opportunities before that. But why does investing early make a big difference? One word: compounding. A phenomenon Albert Einstein coined as the 8th wonder of the world. He who understands it earns it, and he who doesn't pay it. To put it in numbers, say you invest 1000 euro this year and you earn a 10% return on that money. That means you make 100 euro on your original 1000 euro investment, and as a result you end up with 1100 euro. But what if you don't contribute anything next year? Guess what? You'll still make money. Say you earn the same 10% return on your 1100 euro account balance. Now, instead of 100 euro, you earn 110 euro because you are getting that 10% on a larger balance. Now you have 1210 euro. This looks like a small profit, but trust me, this small growth can lead to something extraordinary like a chain reaction. It can be so logic defying that you underestimate what's possible, where growth comes from, and what it can lead to. For example, you start investing at age 25 and invest 1000 euros a month for 10 years in a row. You stop investing at the age of 35 and then let compounding do the magic. Now let's take your friend who begins investing 10 years later at age 35 and sets aside 1000 euro a month for 30 years. At an average return of 8% per year, you would accumulate 2 million euros by age 65 and your friend would have just 1.5 million. That's the power of compounding. It pays to invest early. To paraphrase Ben Franklin, your money makes money and you make some more money on the money your money makes. All you have to do is keep investing and be patient. Remember how your grandfather could watch a movie for €1? Now you have to pay 10 euros or 15 or maybe 20 euros to watch a movie. This is due to something called inflation. Inflation makes prices of products and services go up over time. For example, if you save 10,000 euros this year and put it under your mattress for the next 30 years, when you take it back out, it won't be 10,000 euros. I mean, yes, it'll still be 10,000 euros, but it won't be worth what it was worth when you put it under the mattress. It's the same situation if you leave your money in your bank account. Nowadays, most of the banks pay very low interest rate, which is not enough to counter inflation. The European Union wants to maintain the inflation at around 2%, and that means if you don't do anything, you'll be losing 2% of your money every year. Let's be optimistic and assume you get a 1% interest on your savings deposit. Even then, it means you will be losing 1% of your money every year to inflation. And now with the pandemic and the government's pumping more money into the market, the inflation rates are at all-time highs, and it's going to get worse. The FIRE movement has gained some significant interest among millennials. FIRE stands for Financial Independence Retire Early, and this is something most strive for nowadays. And investing can help you get there. Charlie Munger, the famous American billionaire investor, said, "I did not want to get rich, I just wanted to be independent." Financial independence isn't just about getting rich. It's about the peace of mind that comes from knowing that you can do whatever you want in your own terms. And when you build wealth, you may be in a better position to pursue the lifestyle you want. Suppose you start saving and investing a considerable amount of your income at a very younger age. In that case, you can probably retire at an age of 40 to 45 instead of the normal 60-65. It's about building a financial safety net for yourself. Having more control of your time and money is becoming one of the most important things in the world right now. Most experts say your retirement income should be about 80% of your pre-retirement salary. That means if you're making 100,000 euros per year, you might probably need 80,000 euros to have a comfortable lifestyle. But please don't assume that much of it will come from the social security system, because it won't. Germany established its first social security system in 1889. Since then, the public retirement insurance has been pay as you go, with the current pensions of the retired paid from the current premiums of the not yet retired. That means there is no guarantee that you will be provided with an allowance once you retire. You can't rely on the government to take care of you. Unless you are independently wealthy, you probably need to be soaking away money for your retirement and invest it wisely. But how will you know how much money you need in your basket to retire comfortably? One easy to use formula is to divide your desired annual retirement income by 4%. This is also known as the 4% rule. So to generate the 80,000 euro mentioned above, for example, you would need a nest egg at the retirement of about 2 million euros. This strategy assumes a 5% return on your investment, no additional income, no government support, and maintaining your current lifestyle. Even if we can make 2 million euros by the time we retire, most of us would need some savings nest to provide constant source of income during our retirement. And the earlier we start the process, the more we accumulate. At some point in the life, we all have to stop working. And when that day comes, wouldn't it be nice to know that you have created a way to support yourself without a steady paycheck from your 9-to-5 job? Normally, the word investing is associated with images of men in suits monitoring the exchange of millions of dollars on a stock ticker. You don't need to be the Wolf of Wall Street to start investing. People have been buying and selling shares of companies in the US for hundreds of years. Still, recent changes have made it cheaper and easier even for the ordinary people to start investing in the stock market. We have already talked about inflation and how everything gets more expensive as time goes by. Rarely anything gets cheaper over 10 years. Investing in stock market is an exception. In the early 2000s, brokerages were charging anywhere from 10 euros to 20 euros per transaction to buy and sell stocks online. Fast forward now, the cost of investing has effectively been eliminated and it has become a lot easier. You sign up with an online trading broker like Fidelity, Vanguard, Scalable Capital, click a few buttons, buy some stocks and start investing. It's as simple as that. Elon Musk 3%, Jeff Bezos 1%, Warren Buffett an incredible 0.1%. These are the true tax rates calculated by the non-profit US news agency ProPublica for 3 of the richest men in the United States. What are they doing differently? They pay capital gains tax instead of the normal income tax. A capital gain occurs when you are selling an asset for more than what you paid for it. The most important thing to understand is that long-term capitalized gains are taxed at a very lower rates compared to the normal income tax. All investment income are taxed at a flat rate called the Abgeltungssteuer in Germany. This rate is fixed at 25% with an additional 5.5% for the solidarity surcharge. Now let's check the income tax rates. The top tax rate is 42% for an income above 57,000 euros. So in a tax perspective, it makes sense to focus more on capital gains than the regular income, and the faster you can get there, the lesser you pay in taxes. Also, there are other ways for you to reduce your taxable income. You could contribute to a private pension fund, and in 2021, 92% of the contributions you make to a private pension fund can be deducted from the taxes. That's a huge amount which you can save. A dividend stock is a stock which pays you a part of the profit regularly, called the dividend. I will cover more about dividend stocks in the coming videos, but for now just keep in mind that a dividend is a share of the company's profit paid to the shareholders in quarterly or monthly, like a bonus, and depending on the dividend stock you buy, it can pay you between 1 to 10% of your investment every year. For example, let's pretend you buy a portfolio of 20 dividend stocks that overall pay a dividend of 4% of your total investment. And let's pretend you have just retired after a long and successful career. Hence, you are comfortable investing 500,000 euros of your life saving into this portfolio. Every year, that portfolio of dividend stocks would pay 20,000 euros in cash into your account for just owning them. With so many different options, investing for beginners has become more straightforward than ever before. No matter how old you are or what stage of life you are in, it's never late to start investing. You can't change what you have already done or what you haven't, but you can change your future for the better. And to know where and how to invest your money in Germany, watch the next videos in the series. There we will go in detail about some of the key terms in stock market, make your first trade, and then set up a balanced beginner portfolio for you. Alright, that's gonna do it for now. If you want to know more about personal finance and productivity, think of subscribing to the channel. Until I see you in another video, stay safe, stay happy, bye.